Hey everyone, let's dive right into this. Welcome to today's explainer. We are looking at some absolutely explosive macroeconomic numbers right now. I mean, while much of the global economy is, kind of grappling with crises and slowdowns, we're seeing headline statistics out of India that are literally turning heads. We're talking about a massive 7.7% real GDP growth, foreign direct investment surging toward that $100 billion mark, and an economy that honestly seems to be defying gravity. But what is actually driving this engine? Today, we're going to look under the hood of these massive numbers, break down the exact sectors pulling the weight, and figure out the real trajectory of the world's fastest growing major economy. Let's get into it. Here is a quick roadmap for our explainer today. We'll be covering the 7.7% growth phenomenon, real GDP versus GVA explained, analyzing the sector breakdown, the 100 billion FDI paradox, gross versus net FDI, and finally, headwinds and future outlook. All right, let's start. Section 1, the 7.7% growth phenomenon. Let's really establish the sheer speed of this economic engine. And this brilliantly illustrates the scale of what we are talking about here. India's real GDP growth, and remember, that's inflation-adjusted growth, hit a robust 7.7% for the 2025-2026 financial year. And it gets even more impressive because in the final quarter, from January through March, it actually accelerated to 7.8%. Now contrast that with the global averages. The G7 countries are sitting pretty sluggishly between 1 and 1.6%, and the US is growing at just around 2%. Seeing these numbers side by side really highlights just how distinct India's economic momentum is right now compared to its global peers. It's actually fascinating to look at these current numbers against the backdrop of historical expectations. You might remember that former US President Donald Trump once referred to India as a dead economy. And to be fair, during that period, India was facing some significant headwinds, including tariffs upwards of 50%. Plus, if we look specifically at that recent 7.8% growth in the fourth quarter, well, that happened right when major geopolitical tensions, like the Iran-US conflict, were dominating headlines in late February and March. So the reality of the data we're seeing today has completely defied those past predictions, persisting despite some massive external pressures. Moving on to Section 2, real GDP versus GVA explained. Because anytime we see numbers this big, we really need to understand exactly how they are being calculated. So, the robust figures we're looking at, they're derived from a highly modernized calculation method. The statistical base year was radically updated from the old 2011-2012 standard to a much more relevant 2022-2023 base year, which just better reflects the new modern economy. Crucially, this new series integrates real-time digital data. We're talking things like GST collections, Ministry of Corporate Affairs data, and e-Von digital records. Plus, it utilizes what's called a double deflation methodology, and that drastically improves the accuracy of calculating value addition in sectors like manufacturing. Long story short, we are looking at highly accurate, seriously robust data sets here. Now, a critically interesting concept to grasp here is gross value added, or GVA. GVA is such a vital metric because it measures the actual value of goods and services produced by businesses and farms, completely stripping away the distorting effects of any added taxes or subsidies. You see, sometimes a country's GDP can artificially look higher just because the government collected more taxes. But here, real GVA actually grew by a very healthy 7.9%. And that's huge. It proves that the underlying businesses are genuinely producing more value. It is definitely not just some tax illusion. All right, Section 3, analyzing the sector breakdown. Now that we trust the math, let's see exactly which sector engines are pulling all this weight. So the crucial point here is visualizing the core parts of the economy. The Indian economy is incredibly reliant on the services or tertiary sector, which makes up a massive 54% of the pie. That includes finance, real estate, IT, hotels, transport, public administration, the whole shebang. The secondary sector, which includes manufacturing and industry, sits at roughly 26%. And then the primary sector, driven heavily by agriculture and mining, rounds it out at 19.9%. Right next to that overall weight, let's look at how fast each of these specific sectors is actually growing. The services sector isn't just the biggest, it's also the fastest, pulling ahead with a really powerful 9.3% growth rate. The secondary sector is right behind it, showing a very strong 8.8% growth. That's driven by an overarching manufacturing push, even despite a slight slowdown in Q4. Meanwhile, the primary sector delivered a moderate but completely expected growth of 3.2%. Now I want you to remember this number, 30%. This represents gross fixed capital formation as a percentage of the overall GDP.
And this segment is growing at an impressive 7.8% annually. What does this actually mean in plain terms? It means that 30% of the economy is being poured directly into capital expansion. We're talking new roads, dams, airports, industrial plants, massive infrastructure. The country is consistently increasing its capital budget today to absolutely ensure it can produce more goods to meet the surging demand tomorrow.
This brings us to Section 4, the $100 billion FDI paradox. Let's shift our focus from the economic engine to the actual capital funding it. According to RBI Deputy Governor Poonam Gupta, we are witnessing records-high gross FDI inflows. In the financial year 2026, gross FDI hit an incredible $95 billion. That is a 17% increase from the previous year's $80 billion. And the projections? They suggest this year it will officially cross that massive $100 billion mark, reaching anywhere from $110 to $120 billion. This capital is flooding in primarily because global investors are trying to capture the domestic consumption story, and they want to get in on the ground floor of India's aggressive manufacturing push. For global investors, this is literally the ground floor opportunity of a lifetime. But here is where we hit a bit of an intellectual paradox. If gross FDI is skyrocketing towards $100 billion, why are economists pointing out that net FDI has actually dropped to under $10 billion? Think about it. How does a bucket catching $100 billion end up with less than $10 billion at the very bottom? Section 5, gross versus net FDI. To figure out this paradox, we need to look at the specific math that's draining that net FDI bucket. All right, so here is exactly how that bucket drains. On one hand, we have repatriation, which accounted for a massive $53.5 billion outflow. On the other hand, we have outward FDI, draining another $33.29 billion. When you subtract these two massive outflows from the total gross inflows, your net FDI drops all the way down to just $7.65 billion for FY26. Now, while that is an improvement from FY25, it's a really stark contrast to that huge gross number. Let's demystify these financial terms using some real-world corporate examples. Repatriation basically happens when foreign companies mature in a market and start taking their profits home. Take Hyundai Motor India, for example. They've been making and selling cars in India for years, while recently they launched a massive IPO, sold a 17.5% stake, and sent that money right back to their parent company in South Korea. LG has done similar things. That's repatriation. On the flip side, outward FDI is when Indian giants like Tata, Mahindra, Reliance, or Adani build plants in places like the UK or elsewhere abroad to expand their global footprint. So these outflows, they aren't a sign of some economic crisis at all. They actually represent a maturing, incredibly healthy market cycle. Finally, Section 6, Headwinds and Future Outlook. Let's conclude our analytical teardown by looking at the road ahead. To understand the future, think of an aircraft. You have headwinds dragging the economy down. Because India grew so fast last year, they are now dealing with what's called a high base effect, making it statistically much harder to replicate that high percentage growth. Add to that global trade tensions, geopolitical energy issues, and the looming fear of a global recession lowering export demand. But you also have powerful tailwinds pushing the plane forward. We're talking incredibly strong rural domestic consumption, a relentless manufacturing push, and massive new infrastructure capacity. Balancing all these forces, the RBI and other agencies estimate a slightly moderated, yet still highly impressive 6.5 to 6.9% growth rate for the coming year. And that brings us to our final thought. The underlying drivers of this economy are deeply, deeply robust. Global investors are firmly betting that India is going to emerge as the world's ultimate consumer base. In fact, recent reports suggest India's market could even surpass China's by 2065. So the question I'll leave you with today is this. Can India's surging domestic consumption really continue to outpace global recession fears on its long-term trajectory to the very top? It's a fascinating space to watch for sure, and we'll be right here to break it down for you. Thank you for joining me on this explainer. Keep learning, keep questioning, and I'll see you next time.